Jeffrey Rosenberg, what I see here in the calculus of your Carnegie Mellon is forget about the y-axis, which is where the financial media is. What really changes with these back-to-back labor reports is our guesstimates along the x-axis. How does your x-axis change as you look out into 2021 and into next year?
You know, Tom, it's a really difficult headline number to forecast, right? There was very wide range estimates. And I think the news here on this payroll report is that you're seeing signs of the supply side constraints to the labor market. And you're seeing that in some of the headline numbers. You're seeing that in some of the industry numbers. And importantly, go back to the conversation you had a minute ago on average hourly earnings. Despite a likely mix shift that should have otherwise pushed average hourly earnings downward, we're seeing that increase. And it is a similar story to what we saw in April in that average hourly earnings figure before. So for a long time, we've ignored these figures because they've been very distorted by the mix shift. The fact that you're seeing the increases in spite of the mix shift is really going to feed into this narrative of supply side constraints pushing up wages. The push up in wages will fuel and continue the debate on whether transitory becomes more permanent because it flows into wage expectations. That's to be seen, but I think that's the really important news out of this report today.
Jeff, that's exactly where I want to go. Wages aren't transitory. They're stickier. Once you raise a wage, it's harder to cut it than it is to raise it. So you're going to keep it there if you're an employer, I believe. How does this then fold into some of the break-evens, those inflationary expectations, and we fold over into a 2-year yield that is unch on the day?
Yeah, look, the short-term reactions are parsing the headline, slightly disappointing number versus some of the wage numbers. But the longer-term dynamic is, you know, not only are wage increases sticky, but wage increases is what helps to maintain your real purchasing power, right? And maintaining real purchasing power is how companies can afford to get passed through. So for the decades in which we heard about the inability to pass through price increases to the final end consumer, now you're seeing possibly, and this will be the debate, you know, possibly a loosening in that dynamic that will feed into this debate around transitory versus permanent. But it's an important contribution to that debate from today's report.
So for those folks in the market that are trying to sort of price this out going forward here, Jeff, I mean, we saw earlier in the year there seemed to be pretty broad conviction here about the pace of monetary policy, the renormalization of it. Will, you saw that term premium really shoot up in the first few months of the year. It's kind of flattened out over the last couple of months. And I'm wondering if today's report and the couple other economic data points that we've had over the last couple of weeks is going to change anyone's mind.
I don't think so. And I think what we've had, as you pointed out, right, it was a rapid re-estimation of the economic outlook, the Fed outlook. That flowed through the report, through the market. And now we're seeing a much stronger consolidation. The next phase is really the movement towards the impact on tapering. I think if you look at the totality of today's report, I don't think it really changes the market expectations on the trajectory of that. We'll see some signaling of that to June. You know, mostly it's the end of year into 2022 kind of expectation around tapering. And nothing in today's report really changes that timing.